Good morning, everybody. Happy Thursday. It's August 3rd, 2023. Great to be with all of you today. My name is Bob Lang, and I run explosiveoptions.net. Great place for you to learn about options and options trading, technical analysis, risk management, so forth. We have an amazing chat room with some incredibly bright and studious traders who are there every single day. Over 250 people are with us every day. And you can see there's the chat room right there. You see this morning we have Burge and Nick talking. There's a poll there. Also, me, Aztecs99, TJ, Dave Attardi, and Leanne as well too. So a lot of people participate in chat in the chat room every single day. If you haven't had a chance to check it out, please do. And every Monday and Thursday we get together. I'm in California right now for another day. I'm flying home tonight back to the East Coast. And every Monday and Thursday we get together and talk about markets and where things are at. See if we can figure out where things are going as well too. So let's take a look at things for a moment. So we see the S&P Futures are down about 13 handles this morning so far. The Nasdaq down about 82. Dow down about 60 or so. Volatility is back up on the rise. We did see it pop yesterday quite a bit, about 16% on the VIX, went up to over 16. It went down below 13.5% a couple of days ago. Pretty complacent market, but it's been like that for a while, right? And as we often say, you can't, there's my dad in the background over there. You're on the camera, Dad. As we often say, nobody rings the bell at the top, and let's see how markets do today. We had a horrible day yesterday, thanks to the Fitch downgrading the rating on U.S. bonds for Treasury yesterday or day before yesterday from a AAA to a AA plus. Look, let's face it. Two things. First of all, nobody's going to be selling their treasuries based on this downgrade. Second of all, the Fed and the Treasury are still going to be issuing treasury bonds. That's not going to stop them from doing it because there's still a demand. There's still an insatiable appetite for risk-free assets, and people still have faith and trust in the U.S. government and U.S. Treasuries, right? So that's that. And is it a little bit of a bump in the road? Sure. Was yesterday's drop more than 1%, first time we've had more than a 1% drop in over a month. Was that really driven by the ratings downgrade? Probably not, because we did have a strong month of July. We've had 5 positive months in a row. And listen, at the end of the day, somebody's got to take some profit somewhere, right? And there's a million reasons to sell. There's only one reason to buy, right? So if there's a million reasons to sell, any excuse is good enough to sell your stocks and drop the markets down. So we're not surprised at the weakness. We did hit 4,600 on a close last week, and we pulled back a little bit here. We're down about we're probably down about 100 handles from where we were. The high, what is that? About roughly 2%, 2.5%. That's a mild pullback. Could there be any more behind it? I think there could be. And look at the internals. I'm showing you the internals over here. This is from yesterday. This is the VOLD, the VOLD. This is from Tuesday, and this is from Wednesday. And you can see how poor the breadth was on those 2 days. Also, the ADD, the accumulation distribution line over here. We saw a rise in volatility yesterday, and that gap up stuck all day long, even though we did close towards the lower end. The ticks up here on the top right and the bottom left, the nice ticks and the Nasdaq ticks over here, you can see a heavy concentration of red versus green. And that just means more selling going on than buying during the day yesterday. So not really a surprise. Again, we started off low. We hit our lows middle of the towards the end of the session, and we finished a little bit off the lows. And again, we're pulling back a little bit here today. So on the good news, we did have productivity numbers come out this morning and unit labor costs, and those were extremely positive. The Fed is going to like these numbers. Productivity for Q2 came in at 3.7%, expected it to, off of a horrible first quarter of minus 1.2%. Unit labor costs literally cut in half from Q1, up 1.6% versus a 3.3. So what is this picture telling us? These data points tell us that growth in the second quarter, which we just got those numbers released last Thursday, 2.3 or 2.4%, were driven by productivity, not driven by inflation, and that's going to please the Fed. And as long as these numbers stay up and stay positive, as long as we're getting more productivity and less costs on unit labor, the Fed will continue to entertain the potential for pausing on rate hikes in the next several months. So this is going to be discussed at their next meeting, possibly even in Jackson Hole in a couple of weeks. Of course, the next meeting doesn't come until September, and we do have a job labor report coming in tomorrow. We'll have another one in September before the next Fed meeting. So this is certainly a positive that can be taken away from the data this morning. We'll have a couple more data points later on today as well too. S&P Global U.S. Services number is going to be coming out. You can see that durable goods coming out at 7 o'clock West Coast time. Factory orders about the same time as well too. ISM manufacturing non-business as well too. So a lot of data to come through here. And if it's showing weakness, then it's going to be portraying perhaps some weakness coming in Q3. We're almost halfway through the quarter of the current quarter, Q3. We'll be halfway through on August 15th, so we've got another week to go before we hit that point. So then we'll have a little bit more to evaluate as we move through the month. Of course, the month of August, a lot of people talk about. Listen, you know what? I've had some of the best trading months I've ever had in the month of August. Surprising? Well, I think maybe it is because this month kind of sets up for a lot of volatility, especially when we've had a good rally in June or July as we had in 2023. It sets up for a little bit of more of a defensive posture. So I can trade both sides of the market. I can trade puts, I can trade calls, and I'm looking for opportunities that show up all month long. So again, between the first of the month, which was on Tuesday, down day, it's between the 31st and the 31st. The window is open for trading during this month of August. And again, I'm just going to be looking to take advantage of the opportunities that are there in front of me. So take a look at the chart. S&P 500 yesterday fell below the 20-day moving average. You can see that this dotted line here is the 20-day moving average. The dotted line here is the 20-day moving average. We closed below it, and we're going to probably make a lower low today. If that low today from yesterday holds, though, that would be important. The low yesterday was 45.05. We closed at 45.13. So we may be opening up right near that low of yesterday. If we make a lower low and a lower high from yesterday, that means that the trend has shifted downward, and we're probably going to make a run towards this 50-day moving average. Where is that? 43.94, which is about 120 handles lower than where we're at right now. So that would probably be about another 2.5%, almost 3% down. That would give us roughly a 5% correction from the highs of about 4,600 all the way down to about 4,390. So don't be shocked. Don't be surprised. What you want to do is you want to position yourself for any scenario, right? I've preached it all the time. And again, as the markets were going up, I was preaching having puts on. And by and large, if you held puts, you probably lost money. But if you have long calls or just long positions, you made money on that, right? And the fact that we only use a small amount of our money to buy puts to protect ourselves, that's a small cost for that protection. It's like insurance, right? And we talk about that all the time. Health insurance, life insurance, auto insurance, homeowners insurance, fire insurance. You have to allow yourself a chance to buy some of that insurance just in case a disaster comes along. Maybe yesterday was a disaster. Who knows? Maybe that rising yields yesterday is going to lead to something more ominous in the markets. But you're happy you have that insurance in place to not only protect yourself against disasters, but also to lower the volatility of your overall portfolio. So what would a retreat back to the 50-day moving average look like? So something like we had back in the early part of May, again, got really stretched away from that 50-day moving average. We're really stretched away from the 200-day moving average. Boy, if the market really wanted to correct, another 10% down just to get to the 200-day moving average. Certainly could happen. We had that in February. It looked like we were running away in late January and early February, and we got knocked back down, and we came back down and hit the lows of the year, which happened to coincide and match the start of 2023, which is about 3,800. But we've moved up nicely. S&P 500 is up about 18.5% for the year. Nasdaq up close to 41% in 2023. So it's been a good year so far. Of course, driven by several names at the top of the food chain of the Nasdaq. If that continues on, it bifurcates, and then we see a lot less action on some of the other names, that's going to be a problem. So I want to show you one more chart here. This is the Nasdaq high-low chart. And I usually show you the New York Stock Exchange, NYHL. I'm showing you the Nasdaq this time around because this has been the leader in 2023. And what I want to show you here is that new highs retreated on Wednesday. New lows dominated the scene here. And you can see that by a red bar here. We finished at minus 67. So it tells us what? That tells us that more NASDAQ stocks are hitting 52-week lows than are hitting 52-week highs, right? And we saw in the middle part of July really strong, healthy prints where the NASDAQ stocks were hitting new highs above 100, 150, 200. That has stopped for now, right? So we have to pay attention to this, especially if it starts leading into larger prints like we had back in March. We had minus 600 down in the NASDAQ over here before the markets really started to take off to the upside. We had some very, very large negative prints, new lows swamping new highs in the spring, March, April, and early part of May. When that turned around here, the markets went positive and started to become much healthier. So if this is just a one-off over here like it was in the early part of July, or maybe in the late part of June, then that's just a one-off, and we may see this as a buying opportunity. But for right now, I'm going to hold off and say that, you know what, I want to see a little bit more action and see a little bit more and see if this trend continues to the downside. So that's new highs versus new lows on the Nasdaq. Of course, we got later today. We have a couple big earnings reports coming out, right? In case you've been living under a rock. We have Amazon coming out after the close. We have Apple also coming out after the close. And for some of you who are interested about some of these other periphery names, DraftKings, Airbnb, Square or Block, Cloudflare, Fortinet, Petrobras is coming out, and Coinbase. So I think most people are going to be focused, of course, on Apple and then Amazon. Tomorrow morning we have Fubo, Enbridge, Frontier Airlines, and then Frontier Communications, excuse me, and a couple of other smaller energy names as well too. So those we'll get some action done. And don't forget, tomorrow morning the big non-farm payroll report will be coming out, and we'll get a good read on how the jobs market looks for the month of July. Yesterday's ADP report came out and said that we had a really healthy growth in jobs for the month of July, 324,000 new jobs created on the private side. So, of course, last month when the jobs report came out in July, the markets were down on July 7th. It showed a huge gain in jobs, much different than what we had in ADP. So we'll see if that continues on or reverses in the month of July. So hope everybody has a great day, great trading. Again, use some protection. It's okay. Keep some puts on. It's gonna save you and save your portfolio going forward. We're still at the end of this bear market here right now. We do need to see the S&P 500 confirm on that MACD monthly. Let's take a look at that real quick. Let's see here, SPX. So on the monthly chart, I didn't show this on Monday because of what we were quite at the end of the month. Look, the MACD has already crossed over here, right? So we have a crossover here, even after the last couple of days have been weak for the first start of August. So we have the crossover, right? But what do I like to see? I like to see a confirmation bar. So I got to see one more month. if we get a confirmation bar in August and this stays crossed over, well, we can pull out the dust off the old bull playbook and start using that one. All right. But until then, we're still in a bear market, and believe me, this bear market is not going to go quietly into the night. So that's that. So anyway, I wish everybody have a great day and a great trading weekend, a great trading day tomorrow. Have a really good weekend, and I'll see you guys all back on Monday morning. And thanks for listening, everyone. And I'll talk to you guys all next week. Take care. Bye. If you're in the chat room, I'll see you in the chat room in a little while. Take care. Bye.